You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
You wanted it, you got it. A radio program that helps teach you options trading inside and out. Basic to complex. This is Options Bootcamp. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo, Dan Passarelli, and John Critchley.
All right, everybody, that music means it's time once again for Options Bootcamp, the program for you, the active retail stock trader who's thinking about perhaps dipping his toes in the old options market and perhaps wants to learn a thing or two about how these products work, some basic strategies, some overviews, some tips and tricks from the field, and all sorts of other good stuff. My name is Mark Longo from theoptionsinsider.com, as well as from a little thing we like to call the Options Insider Radio Network. Quite the expansive network it is indeed these days. 13 different programs to suit your various options appetites. If you want some basic education, of course you come here to Bootcamp, but we also have shows for active retail, shows for volatility traders, shows for futures options traders, shows for financial advisors, and those who are looking for financial advisors and want to know what kind of options wherewithal they should bring to the table. All sorts of fun stuff. And where can you find all of that great content? Well, the mothership, the flagship, theoptionsinsider.com. Surf on over there. Click on the Insider Radio Network tab, and you're off to the races. Of course, while you're there, make sure you check out all the rest of our great content, education, analysis, a lot of unusual activity, breaking news from the options market, all sorts of fun stuff. Of course, you can also find the programs iTunes, Stitcher, Aha, Mobile, pretty much wherever you find your finer podcast programs. And if that's all too much for you, don't worry. We made it even easier. We put it all in our mobile app available in the iOS and Android app stores, even the Amazon Kindle Fire app stores. So again, no shortage of ways for you guys to download, stream the program. And then while you're listening, send us some great questions. We love to hear from you guys. And joining me on the old program is my nemesis in life, Mr. Dan Passarelli, the founder of Market Taker Mentoring. Mr. P, welcome back to the program, sir.
Hey, thanks, man. Glad to be back indeed. Let's talk options.
Let's do it. We've got a fun topic to go today. And to make the topic and the show just that much a little more special, we're going to add in a special guest star today. You may know him from his legion of appearances on the Option Block program. He is Uncle Mike Tusaw from RCM Wealth Advisors. Uncle Mike, welcome to this very special appearance here on the Options Bootcamp program.
Always happy to be on the boot camp. I love it when I come in, you guys yell at me and I end up doing push-ups. It's an exciting experience every time.
Which is unfortunate. I have to bring you two sworn enemies onto the same program. I know you and Mr. P have that very blood-drenched history together. And let's just move right along to the basic training segment.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, sir. Call in. Print bear to learn. Yes, sir.
All right, welcome to Basic Training. This is indeed the portion of the program where we break down some basic option strategies, some options concepts that you guys can use in your own accounts. And as we were looking for topics and ideas for this show, we started perusing the archives to kind of see what we touched on, what we haven't touched on in a while. And I was surprised to see that we haven't touched on this topic in quite some time, nearly 2 years. And it's such an important one for our listeners. I thought it was time to revisit it. We've had a few listener questions along the way about this topic, but it is so central to the theme of this show, as well as central to a lot of our listeners. I thought it was time to really revisit it in some depth. This is, of course, the topic we're going to talk about today is using options in your retirement account, in your IRA account. It is one of the primary use cases for so many of you out there, particularly coming from the mutual fund world, from the regular working world, and you have retirement accounts and you want to perhaps maybe jazz it up a little bit with some options, but you're not really sure what you can do out there. And there are a lot of rules, there are a lot of limitations with what you can do out there. So, of course, I think it's time to revisit those. If you want to check out the last time we talked about this, it was way back on episode 25 from July 3rd of 2013. So coming up on 2 years ago now. I can't believe it's been that long, but check out that episode if you want another full breakdown of this topic, but we're going to go into it again. And because it is so important, because it is so confusing, you can't just dive in to your IRA and just start slinging options willy-nilly, doing your iron condors and all these other crazy things that you're used to doing in your regular trading account, at least not without some limitations and some caveats. So we're going to get into those today. And maybe we'll start with you, Uncle Mike, because I know actually one of the reasons we have you on today is because we just got into an interesting discussion about IRAs yesterday and on the Option Block program. I encourage our listeners to check that out if you haven't. And we thought while we're talking about those, it's good timing. It's that time of year. We are recording this, of course, in the middle of March here, getting into tax seasons. People are thinking about tax consequences for options, and it seemed like a good time to revisit the old IRA question. So maybe, Uncle Mike, we'll start with you as our guest. We'll give you pride of place and kind of just a quick once-over on some of the basic rules and limitations that people have when they're thinking about using options in their IRAs. Pretty much basically what can they do and what can't they do.
Yeah, not a problem. What I typically like to go through is what you can't do, because what you can't do takes a lot less time to go through than what you can do. The general rule with most brokers, now every broker is going to have limitations, meaning if your objective is to be extremely conservative and just have long-term appreciation with no speculation whatsoever, if that's what you put down as your objective, then you might have no ability to do any options in the IRA. So it depends on how you state your objective. And usually if you work with the individual broker and tell them what you're trying to do in the IRA, they'll explain to you, well, if that's what you're trying to do, your objective is this, and then if you mark this, then they'll let you do what you're trying to do. So typically, though, the only limitations that exist on the security side of it are you're not allowed to buy stock on margin, you're not allowed to sell stock short, and you are not allowed to sell naked options. Now, let me clarify what I mean by selling a naked option. An uncovered call would be a naked option. So let's say that right now SPY is at around 110. If you wanted to sell to open the 112 call at any expiration with no other option to hedge it or with no stock, that would be an uncovered call. That's not allowed in an IRA. The other thing that I want to clarify on a naked option is when selling short a put. If you sell a put on SPY, let's say, as an example, right now SPY I have trading at 210 or 210.17 intraday right now as I'm looking at on the real-time chart. If you were to sell the 210 put, your risk on that, minus the premium, of course, is roughly $21,000. And so if you have $21,000 in your IRA, then you can sell that put option. If you're in a non-IRA, your maintenance requirement is typically going to be between $5,000 and $10,000, just depending on what your broker allows. However, in an IRA, it's considered a cash secured put, meaning that you have to have the $21,000 approximately minus the premium that you're taking in order to sell that put. So the key point here is a cash secured put. That's allowed in an IRA typically. A naked put, where you only have to put up around 25% of the underlying risk as the maintenance requirement, that is not allowed. anything else that you can imagine, a credit spread, a debit spread, a long put, a calendar, you name it, you can do it so long as it doesn't involve one of those three things.
All this talk of nakedness here. We're going to get the explicit tag on iTunes now, Uncle Mike. So yeah, bring you on the show, and you bring us down that gutter right away, sir.
Oh, yeah, I tell you.
Well, Mr. P, I know this is probably a pretty common topic for you. I'd imagine a substantial percentage of the people who come over there to a market taker on any given day are probably looking for, hey, how do I use these things with my IRA account or some sort of retirement account? So walk us through, Mike just kind of gave us kind of a broad overview. Walk us through some of the strategies you like to recommend for your clients when they're coming to you and saying, hey, what can I do to jazz up this kind of boring old IRA that I have sitting here?
Yeah, as I think we've probably talked a number of times on Bootcamp in the past, I like to break down the universe into traders and investors. And typically, I think if you're using options in an IRA, you're using them as an investor. And so some of the stuff that Mike just mentioned, covered calls, cash secured puts, collars, those are some of the most basic things that I talk about with people who are trading in IRAs. But also, I mean, people who want to be a little bit more aggressive and, maybe they are investors because it's an IRA. It's to grow capital for the long term. One great way to grow capital for the long term is to grow it for the short term over and over again. And so a little bit of trading, I think, is okay in an IRA. It's great if you know what you're doing. So, one of the things that we talk about, of course, is debit spreads. And I tend to have that conversation a lot with people who are trying to use options to get a little bit of leverage, and debit spreads are almost always better than just going out and buying a call or buying a put because you risk so much less capital and you actually can, people don't think about it this way, but you actually can have a higher percentage return if you structure it correctly and it works out, according to plan, of course, as goes everything. I think that, I just kind of like to take a second to echo some of Mike's thoughts and expound somewhat on them about naked options. Mike says selling naked options is not allowed in an IRA. Selling options is not allowed if you're one of my students either. There's no point. A lot of people try and sell naked puts. Of course, this would have to be done outside an IRA because A, they don't understand options, and B, they're trying to get rich quick. I'm actually all for getting rich quick. I think getting rich quick is so much better than getting rich slowly, but losing all your money on one trade is a terrible idea. So in an IRA, using cash secured puts as part of a stock entry / income strategy, fantastic. Naked puts you don't want to do anyway. Naked calls, why? You could do so much better, less risk, same reward with a call credit spread, which you can use, I think, in some IRAs as well.
Again, all this talk of nudity here on the program. I'm not sure what I'm going to do with both of you here. You're dragging us into the gutter. But, it's a good point that people, I think, have this weird misperception when they look at retirement accounts. They think they can't do any strategy that has any sort of short leg component to it. They can't do even a simple vertical because you have to buy one and sell the other. And, I can't do that. That is verboten in an IRA account. And it was like Mike outlined, and Dan, you can do a lot of this stuff that you may not think you can do in there. You can do your basic, of course, go out and buy your calls, buy your puts. You can do the spreads that Dan was outlining, your simple verticals. You can, of course, do those. And all your kind of covered type spreads and covered trades like covered calls, the cash secured puts that Mike was talking about, you can do all of that kind of stuff. Is really, like Mike was saying, really, as long as you kind of avoid the naked shorts and, the extreme margin kind of requirement trades, you're pretty good. So that means you can get into some other interesting areas of things people don't maybe often think about in IRAs, but are still kind of interesting, like we talked a lot on this show. For example, people think they have to just buy a stock and hold it. You can certainly do that in your IRA, but of course you can also take advantage of positions we've extolled many times here on this program, like the stock replacement, buying perhaps a longer term call and now using that in lieu of owning the stock. And you get all the advantages of options that we've talked about many times here on this program. You get the delta, so if the underlying drops, you're going to lose less money as the underlying drops as opposed to owning the underlying itself, which of course moves 1-to-1 with the underlying because it is the underlying. You have the Vega component that'll offset some of the downside. upside and all the other benefits we've extolled many times here on that program. So that's one other thing you can use to jazz up your typical and perhaps somewhat plain vanilla type IRA using options. An interesting strategy we've extolled many times here on this program. It should be okay in your IRA, but maybe sometimes some brokers may perhaps take issue with the fact that, some brokers are less savvy than others, let's say, and they may take issue with the fact that you maybe have a short front month versus a longer term. But we've extolled many times that strategy of taking your regular covered call and then jazzing it up with some stock replacement. So swapping the underlying in for a long-term option, a leap in some scenarios, or maybe a 6 to 8, 10 month type option, and then writing a nearer term option, a front month or even a weekly against it. We have one of our hosts on one of our other programs on the network, Brian Overby, is trying to give that strategy the moniker of the fig leaf. We have a listener question about that a little bit later. In fact, I believe it actually invokes you, Mike, so it's good timing you're actually on the program today. But that's an interesting strategy you can do as well to kind of jazz up your IRA, because at the end of the day, people have this misperception of things that they can't do in their IRA, and yet it is limited, but still you can do a lot with options. Maybe Mike, we'll turn it to you again here before we get into some other topics. As you deal with a lot of people saving for retirement, that's pretty much one of your primary businesses over there as a wealth advisor. What would you say, after having dealt with a lot of these clients for a while now, what would you say is probably the number one misperception they have when it comes to retirement accounts and perhaps what they can or can't do when it comes to options?
Well, I would say just initially that a lot of people believe just the common myth of options being risky, and that while options are risky, they have no part in a retirement account. And this is actually a couple of years ago, true story. And I also have another story that's actually more. I have two stories I'm going to tell. The one from a couple of years ago, I had a client where we had basically a collar strategy for her whole portfolio. And the collar was actually working very well at the time in terms of how we were working it. Sometimes collars work better than others, but in this case, based on what she wanted to be very conservative. And so we set up a collar strategy for her. And so I ended up losing that client. Now, I like a lot of what Dave Ramsey says. I'm a born-again Christian, so I don't want to say anything too bad about him, but let's just say I was not too happy with him that a Dave Ramsey advisor told the client what he told her. He basically said that options are risky, they have no place in your account, and shame on me for not convincing her otherwise, but it drove me insane that that's why she left, is because she felt it was too risky and we were in a collar. Now, with that being said, I said, okay, well, what's this person putting you into? And it was basically something with no downside protection whatsoever. It was like a seasonal timed mutual fund. So I guess that's less risky than a collar. So anyway, with that, it was not it was just kind of one of those things. It wasn't a very big client, but still it was kind of one of those things to where I wasn't necessarily mad about losing business. Stuff like that happens at times. But what I was upset about is that the beloved cause with which we all represent of options was basically smeared upon by that person. And that's what I was not happy about. Now, let's fast forward to just yesterday, actually. I have another client that he had his son give me a call. And so his son is 20 years old, sophomore in college, and he's getting married in a couple months. And so kudos to him. He saved a lot of money throughout his life in terms of working his summer jobs, and he works selling things just as a salesman. And so he sells nutritional supplements, I believe. But anyway, kudos to him. He saved up about $5,500, and he had it in an American growth fund. And so he said that's pretty much everything that he has. And so him and his wife-to-be, they both have jobs, and so they'll have an income. They'll just be a young couple starting off. And so I said to him, I said, are you going to need this $5,500 right now? Because if you're looking to use this as maybe like a retirement vehicle, it might not be bad where it's at. I don't know. Let's take a look at it, et cetera, et cetera. But if you need this now, you've benefited greatly from this bull market these last couple years. And we are at all-time highs right now. And Mark, I got to say it, I'm sorry. I told him, never has there ever been a better time in the history of the entire stock market to sell than right now. Doesn't mean that it's not going to continue to go up, but that is the fact, because we are approaching all-time highs. And so I asked him, are you going to need this money in the early parts of your marriage to pay for repairs in your apartment, to pay for whatever it is you're going to need to pay for, as all young couples are going to be starting out. And so he really thought about it for a while. And he said, I don't think so. And I said, okay, well, how would you feel about that $5,500 turning into $3,500 if the market goes down? Could you handle that? Could you weather the storm, so to speak? How would you feel about that? And so with that, he basically said he could not handle that, because in case he did need the money, that would really hurt him. So what we decided to do, we ended up selling the Growth Fund of America, and we took the $5,000, and I recommend they just put it in a savings account. That's his emergency fund for him and his bride-to-be right now. We took $500 and we put it into a Roth IRA. And what we're doing in that Roth IRA, I haven't done it yet because I'm waiting until we actually hit new all-time highs in the S&P to actually do it. But what I plan to do is basically set up some type of a call spread, whether it's on SPY or QQQ. I'll make up my mind on that when we actually hit the new all-time highs. But if we hit the new all-time highs, what I'll do is some type of call spread where the goal is going to be to make that $500 turn into $900 to $1,000. And the concept behind it is that, let's say he had that $5,500 in the mutual fund and the market were to go up 10%, well, he'd gain about $500 or a little over that. Whereas now what we're going to do is set up some type of a call spread, take on much less risk. And yeah, he might lose $500 out of the deal, but he has an emergency fund now, and he still has a similar potential upside, and it's in a Roth IRA where it was not before. So I think by doing something like that, what we need to do is, what we can do with IRAs is, number one, defer the taxes. But number two, in a situation like that, we have the ability to help people to rest easy at night, knowing that if the market starts, if we have another 2008, I can look that young client in the eye and say, give your bride a kiss and tell her that you were smart and took the money out at the top. But if we do continue to go up, he'll still make a little bit of something, and then he can start saving for his retirement month by month again, and he's in a good spot. So I think that those are two real-life stories that I think are very relevant to, number one, the importance of how you need to understand what options are, but number two, how you can actually use IRAs as an effective tool towards your retirement to meet your own needs.
Well said, sir, and not a drop of nudity in there whatsoever. So
even though it's about a newlywed.
Yeah, that's true. That's true. And Mr. P, I can see you chomping at the bit over there. I know you have a lot you want to chime into on the conversation of IRAs and options. So I won't hold you back, sir. The floor is yours. Have at it.
All right. Well, naked. I just thought I'd throw that in there in case I forget to add that later.
Gotta hit the buzz. That's it. We're on explicit for sure now on iTunes.
Yeah. Yeah, my thoughts are somewhat aligned with what Mike's talking about. I mean, we're at an all-time high, but hey, guess what? You never know. I mean, in 1999 and early 2000, we were at an all-time high and the market kept going up, right? So, like, you never know, are we going to have, our own little version of at least small-time irrational exuberance and the market keeps going higher and we miss out on opportunities or not? And there's different ways to handle that. I mean, me personally, I've moved much more into cash than I have been in the past. Got a rather large percentage in cash right now, but you got to be in it to win it. So I'm not entirely in cash. So one of the things that I'm looking at right now is covered calls where you sell at or slightly in the money calls. Sounds like kind of a crazy idea that goes against the backbone of much of what people are taught. But in this scenario, it kind of makes sense. If I'm thinking about selling a stock right now, I just might end up selling a stock and doing it at a really, really great deal, And if I don't sell the stock and the stock goes up, I might actually still make money. In fact, I might actually make more money than I would have if I just held the stock and didn't sell the call. So, there's all kinds of creativity, and that's a creative strategy that's really not very complicated, but I think it's a little bit out of the box for how some people think. But there's a great way to trade the current market. There's a great way to invest with options given the current market conditions.
Well said, sir. Well said. And only one mention of the nudity, so that was good. We don't get into tax issues a lot here on this show because it's not a tax program. None of us are tax professionals. We like to leave that at the door. But that said, when you're talking IRA accounts, taxes are certainly really a key consideration, and minimizing their impact are certainly the benefits of trading in an IRA account. And Mike, one of the reasons we had you on today is you had a nice educational rant, if you will, yesterday on the Option Block program about this specific topic. It was a pretty lengthy conversation. We don't have enough time to get into all of it here. But maybe you can give us the Cliff Notes version, if you will, here for our Options Bootcamp listeners.
Definitely. Real quick on it, and I can give you the Cliff Note version and the extended version. There's ways with which to download the show from yesterday that I'm sure Mark talks about very frequently. But a couple things I'd want to cover. The first one would be, should I invest in a Roth IRA or a traditional IRA? Well, number one, talk to your financial advisor. If you don't have one, talk to me or your tax advisor in terms of which would make more sense in your specific situation. But number two, oftentimes people are more biased towards a Roth IRA. And my opinion is that I think both of them have a place. Between my wife and myself, we have both. Here's why. We plan to always have to pay property taxes at some point for pretty much the rest of our lives. Property taxes are an income tax deduction, as is giving money to your church, which we always want to do the rest of our lives. And if we do continue to have a mortgage when we're in our retirement years, that's another thing that is tax deductible, the mortgage interest. So a way with which you can kind of have your cake and eat it too, let's say that you allocate some money towards what you're going to use to do one of those three things, let's say. And there's a lot of other examples, but those are the three most common that I like to use. Let's say that you allocate X amount of dollars towards what you're going to use to pay your property taxes when you're retired. Well, if that's the case, a traditional IRA is better. Here's why. You get to deduct the money as you put into a traditional IRA. The money grows and grows and grows, or so you hope. And then when you take the money out to pay for your property taxes, you take it out, you pay taxes on it, but at the same time, you are deducting your taxes when you pay for those property taxes. You're deducting income taxes, you're paying your property tax, or giving to your church, or mortgage interest, whatever the case may be. So for things like that, I think you need to have a portion of your retirement in a traditional IRA, a traditional 401k, or something to where you can get some type of a double deduction, for lack of a better term. I hate to use the term double deduction, but it's kind of what that would be. You can deduct the money coming in, and then you don't pay taxes on it when it comes out. Now, let's say that you're looking to have your other money to buy food, to buy things that aren't deductible, or let's say that you wanted to just take some money out to, I hate to say go to a nude beach, but I haven't said anything about nakedness so far yet. But anyway, you want to take some money out to do something that's non-deductible. Well, if that's the case, then perhaps a Roth IRA might be the way to go for that section of your money, to where the money you don't get a deduction putting the money into the IRA, but when you take the money out, you don't pay any taxes on it. Now, the final thing to mention right now, and this is something else to consider, is that I remember, and Alex Jacobson talked about this a little bit on our show yesterday, but just to kind of add to what he said yesterday, I remember when I first broke into the business, like 13, 14 years ago, I remember just asking the question when I was doing one of my first financial plans for a client, is an IRA distribution, a traditional IRA distribution, taxable at the state level? And in the state of Illinois right now, it's not. 13 years ago, it was not, and I was shocked back then, and I am equally shocked today that it is not. And I almost don't want to say it, because if the Illinois taxing officials hear this, maybe we haven't thought of that one yet. So maybe I'm blowing this for everybody. But the other thing to factor in is when you take a distribution on your IRA, is it taxable in your specific state? That's another thing with which to look at. So I think that both an IRA and a Roth IRA, they're specific tools for specific needs. I don't think one's better than the other. I think it just depends on what you need to do in your specific situation. Once again, myself and my wife, we use both tools. And I think your own situation needs to warrant which one or both of them you should use.
Well said, sir. As always, this is a topic we can probably go on for quite a while on, but listeners, we have touched on it before on the show, but it has been a while. I want to kind of give you a refresher. Again, if you want to check out the full episode we did last time on IRAs, check out the episode 25 from July 3rd of 2013. But in a nutshell, like we said here on the show today, a lot of the strategies you may have thought you couldn't do, you actually can do in an IRA, provided there really isn't any naked short leg or any sort of naked short component to it that requires, the naked short part that really terrifies the world of IRAs. So you want to do your basic bind and call, bind and put. You certainly can do that. Your basic verticals, even a lot of your straight up spreads that don't have any naked short component to them, you can do those, as well as some things maybe you didn't think about, like stock replacements and other fun things like that. So a lot of the strategies you may like, you can do, of course, collars, covered calls, maybe even the quote unquote fig leaf, which we'll get to in a little bit, and some of the other fun strategies. So you can really jazz up your IRA with options in a lot of ways, maybe perhaps you didn't think about before. I encourage you to explore that. And if you have questions about the specific regulations, I encourage you to contact your broker, because at the end of the day, they're the ones who are going to decide what you can and can't do. So contact them. But there are some straight up rules, and as long as you follow those in the IRA realm, you should be okay. And we love to hear if you have questions on this. I know a lot of you have. A lot of you have written in the past with questions about IRAs. It's very much a hot topic for a lot of you. If you guys continue to have questions, by all means, send them in. Maybe we'll bring Uncle Mike back one of these days to talk about IRAs some more. But we do have a little bit of a hard stop on this episode today because Dan's got to run a little bit early. I want to make sure you guys get some of your questions in. So without further ado, let's roll right on into the mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, welcome to the mail call segment. This is indeed the portion of the program where you guys get your chance to really shine here on the old Bootcamp program. I get a chance to put Mr. Passarelli on the back burner because, quite frankly, that guy talks too much on this show, listeners. You guys need to take over. All right. And here's the first question. This comes in from, listener Hector. He writes, can I still trade mini options, or are they no longer available? If you guys are not familiar with what he's talking about, these are the 1/10 sized options on popular products. There were 5 of them to start, and pretty much that was about it. There was the Gold, Spy, Google, Apple, and one other, and there may be Amazon or something else I'm forgetting. And they were essentially designed to trade products like Apple that at the time were $700. They were very expensive, and the options, of course, on those were commensurately expensive. It was a way to allow retail to trade those, because not everyone had 100 shares of Apple lying around. They had odd lots of 17 or whatever shares. So this was a way, at least the concept behind them was a way for people to execute in smaller transaction sizes and kind of speak to some of the sizes that retail actually had in their accounts. It was a great idea. It was kind of rushed through in terms of approvals from the SEC. It took about a year plus to get it all done, which, if you know, from concept to approval is lightning fast in the world of options. It takes usually a lot longer than that for a new product to hit the ground, because everyone seemed to be unified behind this concept. It was a great idea. They launched in March, I believe it was, of last year. And probably about 2 years ago now, I think. And they quickly essentially just withered and died on the vine for a variety of reasons that we've gone into some of the other programs on our network. I'll do a quick rundown for you here, listeners, but essentially the commissions were still way too high. They were essentially regular option commissions on a 1/10 size product. Listeners and retail traders are not fools. They were upset by that, and so a lot of brokers, lost some trades that way. On top of it, the market makers never really embraced these products, so you had full-size commissions and you had very, very wide spreads, much wider than the actual large full-size option spreads, and so you had to pay almost a double cost to trade these things. The commissions were still full size, and the spread was much more than the regular options. You were paying a demonstrable penalty to trade these things. So as a result, as you might expect, no one really traded them, and they kind of withered and died. And it wasn't that long ago we saw, I think it was NASDAQ or maybe NYSE first said, yeah, we're not going to list any future series of these options. And when we see that from one exchange, that's pretty much the kiss of death for a product like that. And essentially, it wasn't long after that we saw. I'm pretty sure, I haven't checked recently, but I'm pretty sure most of the exchanges haven't added any new series. There may be a few longer term, quote unquote, minis still floating around out there, still listed, but there's no one adding new ones to these. So they are effectively delisted. I'm sorry, Hector, if that makes you sad, because you're one of the few people actually out there who wanted to trade these things. That said, Dan or Mike, anything you guys want to add on the mini front? It's kind of a sad topic.
I actually was, for the client I mentioned in the story earlier that had the $500, I actually explored minis for him, but I couldn't justify doing it. The bid-ask spreads it was just painful to even look at, and I'll come up with the right amount of a delta ratio for him when we actually do something this year. But I love the concept of it. For the reasons with which you said, they don't make sense. I had one client, I've looked at them for several clients and just weird situations like that. And I actually used them once on like a 9-lot collar, or like a 6 or 7-lot collar on someone who had like an odd amount of size on GLD, but it was a very long dated one. And I set the collar order out as the combination, and I split the bid-ask spread on it, and it filled almost right away. And this was right when they were first coming out. But since then, I've had no situation to need them. But I want them. I wish they would work, because I would have some situations that would help me just in odd lot share amounts. But they haven't. So, c'est la vie.
Yeah, this has to fall to me as one of the biggest surprises / disappointments I've seen in the option space in a long time, because they were launched with such fanfare. It seemed like such universal support, and so many different constituencies of the options business just straight up failed when it came to this product. The brokers really screwed it up. The market makers screwed it up. And there's reasons behind all of that. I won't get into that. There's a lot of behind the scenes backroom stuff. But quite frankly, everyone dropped the ball when it came to this. Even on the platforms, you go to a brokerage platform, trying to find these things. I mean, I'm a professional. I do this day in, day out. I'm always looking at platforms and things. I sometimes had a hard time trying to figure out where these minis were, how they were being shown. There was no standard, really, no standard way to display them alongside the regular one. So the quotes were kind of buried. It was a drop ball across the board. And you're right, Mike, it's a shame, because these products had a clear use case, particularly when Apple was pre-split and $700. That was a great use case for it. And other ones are still out there. Google is still an expensive name. There's other names out there that are pricey. But it just, for whatever reason, has failed, unfortunately. So I'm sorry, Hector. But yeah, there won't be any new minis coming. You can probably still find a few maybe floating around out there. But yeah, I wouldn't expect deep liquid. I'm surprised, Mike, you actually got filled in that one mid-market. That surprises me on that story, because you didn't see a lot of people really stepping up to fill anybody in those things. That was part of the problem. We got time for another one here. This comes from Neil Cerone. Hopefully I'm pronouncing that right there, Neil. He writes, what are the most common mistakes you see from, quote, stock guys who try to become, quote, options guys? Dan, this is essentially the entirety of your business. So I will let you go first. What are some of these mistakes you see from these crazy stock guys who want to become options guys?
Yeah. Oh man, you're right. This probably is a good 80% of my business. People who trade stocks and are good at it, 95% of the time fail trading options, because here's what they know about options. Oh, well, I can use options as a substitute for the stock. Oh, okay, that's what options are. Well, no, that's 15% of what options are. The guys who are successful trading options trade the actual optionality. They trade the volatility component. They use the time decay to their advantage when necessary. They trade strategic spreads. I mean, if you're a stock person and all you know is direction, you can use options for direction, but you've got to consider the other factors that go along with it. Otherwise, I don't make a lot of guarantees in my business, because everybody knows the market can't be guaranteed. But I guarantee if you just use options as a purely directional thing and you don't consider things like volatility and spreads and more complicated risk reward questions, you're guaranteed to fail. Really, I mean, that's what goes wrong. That's how the wheels fall off the bus, is underestimating and underestimating isn't really the right word. Not taking full advantage of what an option is, and not trading options as options, but trying to trade options like stock. If you're trying to, I don't know, I can't even think of an example. If you know how to ride a bicycle, but now you're trying to drive a car, I mean, you can't drive a car like a bicycle. Stay off the bike path. It's not going to work out. use the turn signals. Don't stick your arm out the window. I don't know. I guess that's a ridiculous example. Maybe we can have Kyle edit that one out. But don't try and trade options like stock. Try and trade options like options.
And next up, we have a question here from Steve. He goes by Hawkeye. He's written in many times to our network. Actually, I had the privilege of meeting him once, as he'll write here in a minute. I think Uncle Mike did as well. He writes, first off, I love all the shows. They fill my daily commute with wit and wisdom. Thanks. Well, you're welcome, Steve. Listeners like you are really the reason we have this network and that we crank out so much content on a regular basis, on a daily basis now, actually, listeners. So a lot of great stuff coming out there for you guys. And hopefully it's not overwhelming, so much content, but we love to put it out there for you, all free of charge. It's all for you. He goes on to write, also, better late than never. It was great meeting you all at Benny's Chophouse back in September. I'm one of the Lobster and Meatballs trainees. Thanks to your shows, I had the pleasure of sitting right next to you and across from Uncle Mike. There we go, Mike. As we devoured steaks on the Greasy Meatballs tab. That would be extra pleasure as Sebastian was paying for them. So what he's referring to, listeners, is we do another program on the network called The Option Block. We do it live sometimes. We did it live last year at a steakhouse here in Chicago, and this is one of our listeners who flew in to attend the program, and we love to have you guys coming in live. Maybe we'll do a boot camp live one of these days as well. That would be fun. He goes on to write, give me a little bit of a hard time here, actually. He goes, however, I got to tell you that me blew it big time the other day when trying to describe why a leap call diagonal is called the, quote, fig leaf. He mentions Brian. That's Brian Overby. He is the senior options strategist over there at Trade King, also the host of our Options Playbook radio program, airs weekly here on the Options Insider Radio Network. You can also find it over there at optionsplaybook.com or just search for it iTunes or wherever. If you like this show, listener, you should be checking out that one. It's a weekly short, about 15-minute narration, a little dissertation on a different strategy, a different options topic, a trade, a trend, a tactic that you guys can use in your portfolio. Nice bite-sized, digestible chunks. If you like this program, you're going to love Playbook. You should be checking it out. And Brian and I had a conversation on that program very recently about that strategy I mentioned earlier in the program, the whole buying a long-term covered call, buying a leap option, swapping it in for the underlying in that covered call, and then writing a near-term, a front-month covered call against that, and he's trying to get the title going of that for a fig leaf, and I kind of threw together a kind of haphazard description of why that was, and Steve here is taking me to task. He says, Brian named it the fig leaf because you are kind of covered, quote, but not exactly, due to the curves in the profit graph. I think that makes perfect sense and is pretty funny to boot. Mike, it's a good reason you're on the show here. He actually mentions you here again. You're getting a lot of love on the show today. Because finally, on a side note, I'd love to hear Uncle Mike explain what is and is not considered holding in the NFL. It boggles my mind to see play after play of inconsistent enforcement. I understand that's out of your scope, but what the hell, I thought I'd ask anyway. It's not too often you meet a pro lineman. Best regards, Steve, a.k.a. Hawkeye. Well, a lot to digest here. Maybe, Mike, we'll start with the options-oriented bits, and then maybe if we have time, get into the football part at the end. But maybe I'll start with picking your brain on that. What's your thought? I kind of put it out to Dan before, and he was maybe a little bit not enthusiastically endorsing of it, let's just say. But Brian's trying to get some momentum behind this, calling that strategy of a fig leaf for the reason Steve describes here. Hey, what's your opinion of that strategy? I know you're pretty much a fan of it, but give it to our listeners who maybe haven't heard it before. That kind of long-term stock replacement with a covered call type strategy. And then B, what's your take on this whole trying to call it a fig leaf? And then C, if we have time, we can get to the holding conversation.
All right. In terms of the strategy itself, I think I guess this is like a hair club for men question. Not only am I a spokesman, I'm also a client. In terms of the strategy, I don't like it. I love it. I think that there's a lot of things with which you can do on it. I especially love it in the lower volatility environment because of the fact that, let's say XYZ stock is at 50. And instead of just buying XYZ stock at 50 and selling, let's say, a 55 covered call on it, what you can do is maybe buy the 40 call, the 45 call, or even the 50 call, depending on how volatility is. And you can actually write that call against it. A lot of times you can get a pretty decent amount of time decay working in your favor. And by doing that, the risk that you take off the table is significant. So I'm a huge fan of the strategy for many reasons. The other thing that I like about it is, let's say that you still want to Perhaps you still want to do something like it, but you don't want to limit upside, or volatility might be a little bit higher. Some of the things with which I'll do, I'll keep some money on the sidelines, and instead of selling a short-term call against a long-term call, perhaps I'll take some of the money that's on the sidelines and then perhaps sell a put credit spread. And by doing that, sometimes you can take advantage of little spurts of higher volatility if you get it, and then not limit upside, and you're essentially buying the dip. So I really like the strategy. The second part of it, in terms of calling it a fig leaf, because you're kind of covered, you're kind of not covered in terms of like the risks and rewards. I really like Brian Overby. I get the pleasure of meeting him, almost 10 years ago. And just because we both had a little bit of a history with Options Express from back in the old days, but we were never there at the same time, but we kind of knew each other when we'd run into each other when he was first starting out with Trade King. He's a very nice guy. And, but with that, the fig leaf though, don't know if I quite buy into the fig leaf as the name of it. I think that with the creative names that exist with option trading, a condor, a butterfly, I think we need to go something more along the lines of like a bird. So what bird it should be, I don't know. But the fact that we have birds in our option trading strategies for spreads, I think that's the direction with which we need to go on it. And Mark, since you have your little birdies, maybe you know of some good birds.
Yeah, this is one I applaud the effort, because I think we need to do this. I think we need to come up with better terminology in the options world. It's one of the things that's always frustrated me. Some terms are just so absurd, like front spread and back spread. They have no real derivation that makes any sense. They confuse newcomers to the space. They're just terrible. And in this case, this is a strategy that really has no terminology. One of the few in the options world that doesn't. I talk about a strategy a lot. I always say kind of long. It's a mouthful. Long-term stock replacement with covered call. It doesn't. None of that really rolls off the tongue. So I'm definitely a proponent of giving this a better a better title. I know Brian didn't come up with this himself. I think he actually polled some of his clients over there at Trade King, and someone on their community came up with this. And I could see why. It does take a little bit of explanation to say why, which is probably maybe why I'm kind of less of a fan. I like titles that are a little bit self-evident. Steve says this is, and I think for a lot of the listeners out there, it may not be. So I'm kind of with you on that camp. I'm not really overly enthusiastic of this title. That said, if it sticks, it wouldn't be the worst thing. It's better than saying long-term leap, covered call, replacement strategy. That none of that really rolls off the tongue. So I'm open to that. I'm not sure if fig leaf is the one. Again, you think about it that way too. Iron condor doesn't really, it's a butterfly with bigger wings. I could see that, but it's still more spread out wings. But still, that isn't really intuitive to the average user as well. So maybe we need to sit down and rethink all of our terminology in the options world, and with the goal of making it a little bit more penetrable. Speaking of making things more penetrable, we're running out of time, but I'll give you a couple of minutes if you want to indulge our listener here, Mike, because I'm not sure a lot of our listeners know, but in your previous life, before you became the options devotee that you are today, you had a little bit of a foray in the NFL. So indulge our friend here on what the heck is holding these days.
Absolutely. Holding is something that could be called on every play in theory. It's a very gray area in a lot of ways. I'm actually the offensive line coach at Aurora Christian High School in Aurora, Illinois. 2 state titles in the last 4 years, by the way. And I'm probably the biggest non-holding advocate in the state and the Illinois High School Association, quite honestly. In the NFL or in high school or college or whatever, whenever you grab the guy inside of his frame, meaning like on his chest, it will not be called as holding. However, if he moves and you're still holding on to him, then it will be called for holding, meaning he gets your hands to come out of the frame-to-frame alignment. But if the hands are inside the frame, then it's not going to be called for holding. On the NFL films, you'll hear coaches say, keep him inside, things like that, and that's what they're referring to. The other thing that I want to mention in terms of the gray area of it, my senior year of college, we were playing Missouri Western in St. Joseph, Missouri Southern versus Missouri Western, for all of you MIAA Division II football fans out there. And I literally was holding a guy inside the frame, But he moved, and I had him gripped so tight that his jersey ripped right off. I literally ripped the guy's jersey to shreds.
Getting back to our naked theme of the show here.
Getting back to the naked theme of the show here. And the guy just goes to the referee, and there was no call on the play. And the guy looks at the referee. He's like, I don't know what else you need to prove to you that this guy is holding. And I said, oh, come on, you did that yourself. So anyway, that's my holding story for the day.
So the moral story is it's kind of vague and nebulous, kind of like our options terminology. Sometimes,
it really is.
Sometimes it makes sense, sometimes not so much. So that's probably the best we can do for you there, Steve. I'm glad you came out in defense of the strategy. Glad we saw you at that event. Glad you write in. Keep doing it. Keep listening to the shows. You guys are the reason we do these programs. But unfortunately, that's all the time we have for the mail call segment. It's also all the time we have for this episode of Options Bootcamp. But before we go, as always, let me check in with each of my cohorts here on the old Options Bootcamp Drill Instructor Squad. See what they have cooking that may interest you. Starting off with you, my regular co-drill instructor, Mr. Passarelli. What's cooking in the land of market taker mentoring?
Oh, we are just about at the point where we're going to close the door on our options training retreat in beautiful, scenic Sonoma Valley, California. That retreat is planned to take place in mid-June of this year. And boy, we actually had a lot more interest than I had expected. And we can really only take a certain number of people, per our planning, because, the hotel, conference room is only so big, and the place that we're having the reception is only so big and such. So our class is almost full. If anybody has any interest in joining us in Sonoma Valley in mid-June, visit markettaker.com/Sonoma. Market, like stock market, taker, like you take something, 2 T's in a row, markettaker.com/Sonoma, and read about it. Sign up soon, because we're closing the doors pretty soon on that one.
And I got to say, I thought it was beyond generous for you to send me those all-inclusive comp tickets with flight, first-class accommodation, every meal paid for, just to attend your event. I thought that was really above and beyond, sir. So my wife and I thank you for that, and we'll be seeing you out there.
Shucks. Well, at least you're not bringing your extended family, too.
Yes, I cut that off there, but I do appreciate that, sir. That was above and beyond. But in all seriousness, listeners, surf on over to markettaker.com. Don't forget the 2 T's. I sometimes forget that myself. 2 T's, marketandtaker.com/Sonoma. Check it out. It's actually a pretty cool event. Certainly looks pretty interesting, and I'm teasing Dan. I do want my all-inclusive, because there's few parts of the country I like more than that Sonoma, Napa area. So I don't need much of an excuse to head out there. You guys hitting the wine train while you're out there?
I don't know about the wine train. We're actually, what we're doing is we're having a networking reception at just one of the top-notch wineries out there. It's called Williamson Winery, and that's going to be like a 3-hour event where we've got some great food stations set up for pairing, cheese pairing, food pairing, some of their incredible wines, and man, there's some great ones there. So we're busing all the students there, and that's going to be really fun. That's going to be
got it. You can do the wine and cheese pairing and talk about pairs trades with options. Done. I'm writing it for you. Now I need to have my comp ticket. There we go. See, I'm doing your work for you.
Marketing guy, send me a bill.
All right, check it out, listeners. Markettaker.com/Sonoma. All right, thank you for that, sir. And last but not least, since you are a guest, sir, I want to give you a chance to plug to our listeners anything you may have cooking over there at RCM Wealth Advisors, RCM Alternatives, RCM Futures, any of the myriad branches you guys have over there that you think may interest our Options Bootcamp listeners, sir. The floor is yours.
Well, with IRA season being in full force, a lot of people have not done their taxes yet. It's not too late to put in your 2014 contribution, whether it's Roth, traditional, whatever the case may be. We're leaving it open to new clients right now. That'll probably be closing up for a while because we can only handle so many at a time. But for right now, until April 15th, when it's for the remainder of, or approximately April 15th for the remainder of IRA season, if you have any questions on that or are looking for an advisor in any way, shape, or form, this is an open period with which we have. Feel free to give me a call directly, 312-212-3531, or send me an email at mtusaw@rcmfs.com.
There you go, listeners. Check it out. Give him a call. Shoot him an email. If you like what he said on this program, you'll like what he can do for you as well. And on behalf of Dan and, of course, our guest, Uncle Mike, and indeed myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the program and for sending in such great questions. Keep them coming, even the tangentially related to options questions. And we'll see you next time right here on Options Bootcamp.
Options Bootcamp is produced by the Options Insider, Inc. All rights reserved.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.